Let me start off by asking what's driving investor sentiment at the moment? Is it fear, greed, fear of missing out, complacency?
I think that, as it often does, the market has flipped from being all good to all bad. And, you know, prior to October the 4th, it was ignoring some possible problem sites, and now it's obsessing about them. That's the way it goes.
You know, in January, your memo was sort of pretty sanguine about the various risks that could potentially result in a market downturn. Things like the trade war, things like geopolitics, are sort of, you know, I guess more of a moderation in corporate earnings. We'll get a bit of a picture this week, of course. Has that shifted somewhat? Have you become a little bit more pessimistic?
I have been calling for caution for some time now. You know, I think that the fundamental decision that an investor has to make is whether to be aggressive or defensive, and I have had more of an emphasis on defense for a good few years now. I think that the easy money had been made, and it's important to know where the market is in its cycle, and I think that it's high in its cycle. That doesn't mean it's going down tomorrow. I think that the economy is very powerful. I think it would be difficult to be out of this market, but I think if one should be in a cautious way.
You don't like to talk about the market cycles having a beginning or an end.
Right.
So let me ask you, where are we at roughly in terms of the closeness to a downturn, or how far are we from the midpoint?
Sure. Well, in the investment business, there is no such thing as certainty. We sometimes have an idea where we're going. We never know when. So I can't tell you when it's going to stop rising and start falling in a serious way, or if it already has, for all we know. But I think that we've been in the middle of a long economic recovery, a long bull market. The S&P, for example, has quadrupled from the lows. Because interest rates are low, a lot of money is in the hands of people who want to put it to work, which is a bad thing for discipline and prospective return and structure. So I think that, you know, I've been saying for a while we're in the 8th inning. That hasn't made me right. But of course, remember, for those in Australia who don't know, that while a baseball game has 9 innings normally, we don't know how long this game's going to go in the market. So while I still feel good about saying we're in the 8th inning, it may be about to end, or it may go 9, 11, or 14. Who knows?
In the meantime, though, you know, it still feels like a momentum-driven market, right? It remains a challenging market for value strategies. I want to throw up this chart in our GTV library looking at the divergence between returns on value and returns on growth, and that's diverged regardless of whether you're really looking at large caps or small caps. In fact, I think we're talking about a 15% cumulative loss for value over the past decade or so. We saw that kind of repeat itself from what we saw in the 1950s. Is it hard to defend value investing when you see numbers like that?
Well, remember that what you've shown here is only showing months. It doesn't tell a big fundamental picture when you show a chart of months. The point is that when investors are optimistic and future-oriented and sanguine and excited and all those things, then stocks which are expected to deliver the future, growth stocks, do the best. But eventually it's corrected. Nothing does best forever. And if you showed a, you know, I remember 1999 was probably the worst year in history, and growth stocks outperformed value stocks by 25 percentage points in 1 year. But when the tech bubble burst, that was reversed in 2001 and 2. So nothing can do better forever, because if one group does better than another group long enough, it becomes overpriced relative to the other group, and then some discipline comes in and it gets corrected. And I wouldn't bet on it. Trees don't grow to the sky.
We've had 2 key moments in the markets this year. One was the February bond market-driven sell-off, and the recent one we had just a couple of weeks ago. Are you seeing a recalibration finally, rotating from everything growth to looking at value?
I don't spend a lot of my time in the stock market, but I do think that, you know, the growth stocks ride high on optimism, which means that they become vulnerable. And when the optimism is taken away, then their vulnerability results in losses. And it'll ever be so.
As you mentioned, you only have, I think, about 4% allocation when it comes to listed equities. A lot of that is in emerging markets. So talk to me about your EM strategy in terms of making the most of inefficient markets. And you say, you know, everyone says it's like catching a falling knife if you go into Turkey or Argentina right now. You think that's when you should get in?
I would rather be into things that people dislike than the things they're in love with. Clearly, some of the emerging markets are disliked. The prices have fallen. The fundamentals are negative. Have the prices fallen enough, or too much, or just right? That's the judgment that our experts will make.
Central bank normalization was the other big theme going into the start of this year, and it's going to be the big theme going into next year as well. Right. Is that something that worries you in terms of the impact on the cycle?
You know, first of all, the central banks have to embark on this process you call normalization. It's never really been done before to the extent that it's called for. Nobody can tell me, to my satisfaction, how that's going to go. You can't say how something that's never happened before is going to go, number one. So that's an area of uncertainty. Number two, part of that normalization will be an increase in interest rates. In the states it already has been. And when rates go higher, number one, the economy slows down, and number two, fixed income instruments provide more competition to stocks. These are facts of life. The amazing thing for me, Heidi, is that rising long-term interest rates were described first, I think, among the factors that caused the U.S. stock market to start to fall on October 4th. How can that have come as a surprise? I mean, you know, Bernanke mentioned the likelihood of the reversal of stimulus years ago. The Fed has raised rates 8 times, and everybody knows they're going to raise it 5 or 6 more times. And while short rates were rising, long rates weren't. But how could it come as a surprise that eventually long rates would start to catch up? And I think that this is an example of the lack of insightfulness in the investment markets. You know, that people were in a good mood, so they ignored the likelihood of interest rate increases, and then they happened, and they were taken by surprise. How could that have become a surprise? And you know, in the real world, things fluctuate between pretty good and not so hot. But in the market, investors go from everything's perfect to everything's terrible. And one of the messages of the book is that when people succumb to their emotions in these ways, they really are not in charge of their process. And if you want to have better results than most, you have to have some control over your emotions.
But that's what humans do. That's
what humans do.
That's why you don't get a binary reaction in most scenarios.
Exactly, but that doesn't make it right. The great investors that I know have their emotions under control. Your emotions, if you think about it, will make you excited when things go well and cause you to buy when prices are high, and get you depressed when things go poorly and get you to sell when prices are low. And clearly that's the opposite of what we should be doing. And the essential ingredient in not doing it is getting your emotions under control.
The current economic recovery is one of the longest ever. Valuations are some of the richest ever in the US. At the start of this year, you said, you know, it's plodding along. It's not so hot that we're going to see the end very soon. Has that view changed? You've got more voices talking about a recession in the next couple of years, potentially.
Well, I mean, look, our economy is still doing very well. In a few months, it will become the longest recovery in history. And I don't believe there are signs of recession anytime soon. In fact, you know, in December, the government passed the tax bill, which will be highly stimulative. It has produced a gangbuster second quarter this year. The third will probably be somewhat less than that. But I don't think there's any reason to expect a recession anytime soon.
I want to get your views on Asia, because this is an area that, you know, we look to China and it does, you know, there's the narrative is that if China sneezes, the rest of Asia certainly catches the cold. We've got the trade war and the you know, implications for supply chain disruption on top of that. Do you see opportunities given all of the uncertainty in this region?
Yes, I would say so. The emerging markets, we look at them as a group, you know, have been one of the worst performing groups in the stock market. We like to look at the areas where which are unloved. Now, we don't buy just because things have gone down, and we don't buy just because things are unloved, but it is a very good starting point for investigation, and we are very active in that regard.
It's also, you know, emerging markets and Asia, you look at these economies that have very strong domestic narratives, right?
Yes.
All of that kind of gets chucked out the window when you look at valuations where they are compared to US stocks.
Sure.
And in the debt markets as well. Is there a sense that the politics of the US is holding the rest of the world hostage in that way?
Well, I think certainly the politics in the U.S. makes the world a more uncertain place than I should say, an even more uncertain place than it usually is. It's clearly not the only thing going on. Some of them do have good domestic economies. Many of them will have issues with repaying dollar-denominated debt. And like everything else, there are pros and cons. I can't sit here and tell you whether they're a buy or a sell. They have to be evaluated individually. But the one thing we know is that they have been under pressure.
You're, amongst other things, very well known for being very aggressive, very decisive in the wake of all the uncertainty following Lehman Brothers. You know, 10 years on, do you see a bet in this world that would be the equivalent of how much of a risk you took there? I know you spent a lot of time looking at risk as part of researching and writing a new book. No,
I think Heidi, that most things are kind of in the middle. Now, I think things are on the high side in the U.S. and maybe in Europe, but especially in the U.S. I think that things are on the high side of the middle. I think of ranges of things of rich, fair, and cheap, and nothing is cheap in our markets, and most things are between the high side of fair or the beginning of rich. And you know, this is not a very good time for bargain hunters. We're not having a great time in that regard. There's no fun in that. But I think, and clearly there are no risks comparable to the risks that brought on the global financial crisis today, in my opinion. You know, think of it. Anybody who came into this market or this business within the last 20 years, what did they see? They came into the business in '98. They saw the tech bubble burst in 2000 and the subprime bubble burst in '07, '08. They've seen two bubbles burst. They may have the impression that every rise is a bubble and every deflation is a crash, but that's not the case. We can have moderate overpricings, which turn into moderate corrections. Not everything's a crash. I don't see a risk comparable in scale to '08.
Not even in tech, because I want to draw your attention to something that you said about SoftBank, the investment in Vision Fund, the euphoria, which, you know, has been in the headlines due to everything that's been going on with Saudi Arabia, of course. But you said the willingness of investors to invest in a shockingly large fund for levered tech investing with a questionable structure is further indication of an exuberant, unquestioning market. Do you think, you know, has that changed given that we've seen the sell-off?
No, look. I think I take all these things. I talk in the memos over the last year and a half. I talk about things like the U.S. stock market, the FANGs, the credit market, SoftBank, venture capital, private equity, Bitcoin. I'm not expert in any of those things. I'm not making conclusory statements about any of those things. I use all of them, including the creation of the SoftBank fund, as signs that we're in a market which is marked by optimism and credulousness and greed and fear of missing out, as opposed to pessimism, skepticism, and fear, and especially fear of losing money. So when I conclude that the market is optimistic and aggressive, then I turn cautious. And if I want to know the emotional content that others are supplying to the market, and for the most part, I want to do the opposite.
So Oaktree's tenet, one of them, is to move forward, but with caution.
Yes.
I mean, what would you say to a cautious investor who wants to do that? Move forward. You don't want to be miss out. You don't want to be sidelined. Right. What does that look like in the last quarter of the year and going into next year?
Well, first of all, you know, we're not market timers. We don't claim to know what's going to be right for the fourth quarter or any other quarter. But we are move forward, but with caution, which has been our mantra for the last few years. Move forward means invest, and we're investing every day, and we are endeavoring to be fully invested, but we're doing it with caution. And since we consider ourselves a cautious firm, that means even more caution than usual. We're not going to cash. Everything you want to do in the investment business, stocks, bonds, high-yield bonds, emerging markets, whatever it might be, picking mutual funds especially, there are ways to do it which are aggressive, and there are ways to do it which are defensive. And I think the most important decision at a point in time is for the investor to make a judgment on how to balance those two. Should you be worried about losing money today? Should you be worried about missing opportunities today? Probably both. But in what weighting? I would weight it towards worrying about losing money. I would weight my portfolio toward defensive things. So if you want to go into a high-yield bond mutual fund, you might look for a manager who has a record of fewer losses in bad times, albeit at the price of not being a full participant in good times, as opposed to a manager who is great in the bull markets but gives it back in the bear markets. There are different tactics to choose, and I think this is a time for defensive tactics, but I'm not calling for cash at all.
You've written about President Trump being, as an early indicator, pro-business with his tax cuts. He's talking about more tax cuts now going into the midterms. Do you think the US is on the right track? It's a very broad question.
Well, it's a very broad question. But I think that it has been very good for business and the markets to have a pro-business president. And I'm not going to talk about anything here which is not related to business and the markets. Now, when you say that they're considering more tax cuts, you know, look, we have a healthy economy in the 10th year of a recovery. There's never been a recovery that went more than 10 years. I don't think it's desirable to continue to stimulate and stimulate and stimulate and stimulate the economy to make the recovery go on forever. Because the nature of things is rise and fall, rise and fall. And if you want it to rise forever, you're going to do stimulative things that result in excesses which exacerbate the fall. We have a healthy economy. It doesn't need stimulus. Doctors don't give adrenaline to healthy patients. And I would rather not see stimulus in the 10th year of a recovery.